George, it's great to have you back on the show. We recently got back above 1450 to levels that we haven't seen in gold since April of 2013. Silver reached 12-month high. Is this recent run-up sustainable, and do you think there's more to come, George?
I think it's definitely sustainable. I think there's a whole bunch of different reasons as to why we got up above 1400. What essentially we did, we broke out of a trading range that had been in place since the spring of 2013, as you say, and we now seem to be comfortably above what had been the top of that trading range. I think that this is sustainable. I think there's a lot more to this rally than just Fed Chair Jerome Powell promising an interest rate cut at the meeting at the end of this month. I think there's an awful lot more things going on in gold right now. I think that we could well see further growth. I wouldn't be surprised to see a small pullback. Gold may need to do a little bit more work in what had been the area of resistance between 1,350 and 1,400. But that doesn't look like it's going to be happening today or anytime soon. So I think that we could well be set for higher prices.
George, in your notes, you mentioned how holdings in the global gold-backed ETFs and similar products rose sharply in June by 127 tones to 2,548 tones, equivalent of US dollars of 5.5 billion in inflows, according to the WGC. Now, what do you think is behind this appetite for ETFs as a vehicle for access to gold?
Well, look, I think, the market accepted ETFs pretty quickly. The partnership between State Street and World Gold Council brought GLD to market back in 2004, effectively democratizing gold investment. We reached $1 billion in assets under management in the first 3 trading days, the fastest ever ETF to reach $1 billion. And I think that investors have really embraced it with what with almost $40 billion now in State Street gold ETFs. I think investors tend to vote with their wallets. There's no doubt that they've embraced ETFs as a cost-effective, efficient, transparent, easily tradable vehicle. It made gold accessible to a whole universe of investors who hadn't thought of gold as an investable asset before that. And I think that, all of the different kinds of gold investment have coexisted, but I think that we are going to see more and more moves into ETFs like we saw in June, as you pointed out.
And you expect to see increased popularity?
I think no question about that. It is such an amazing vehicle that and investors have embraced it with great enthusiasm. People are still buying the traditional bars and coins where they don't have highly regulated, transparent ETFs, and that's an awful lot of the world. But I'm expecting ETFs increasingly to take an increasing share of the investor dollar.
George, over the past years, gold's provided a safe haven for, as you put it, investors who seek to preserve wealth and pass it on. Can you elaborate a bit on why you think, until Bitcoin can provide that safe haven and effectively transfer and preserve wealth, how you think it's premature to call Bitcoin gold 2.0?
I rather like working in the gold business, Ben. Being able to say, gold has thousands of years of a track record as offering some protection against the unexpected, whether your tail risk is macroeconomic or geopolitical, whether it's inflation or wars or pestilence or whatever it may be, is to me comforting to know that there is that thousands of years of a record behind it. Bitcoin is the oldest cryptocurrency, and that has been with us for just about a decade now. So it doesn't have anything like the same kind of track record. And there are people who complain about gold being a volatile asset. I think that's largely a misunderstanding about the nature of gold's volatility. But the cryptos last year lost 80% of their value. They've recouped a lot of that this year. But, that to me says that screams volatility, and that's not the kind of asset that I want in my portfolio to lend stability. And I don't think that we're seeing people make strategic allocations to cryptos in the way that they have been consistently making strategic allocations to gold. I think people view it much more as a casino chip. They'll buy it when they think it's going up. They'll sell it, as we saw last year, when they think it's not going up. I just don't see really a link between the two. Bitcoin is certainly not gold 2.0.
Noted. It's like comparing apples and oranges in many ways. George, what's your outlook for gold throughout the second half of 2019?
I had been looking for gold to spend some time above that 1,350 area, which had been the top of our trading range. I've been very pleased to see that we breezed through that with no hesitation whatsoever. The hedge funds did not play their traditional game of whack-a-mole every time gold poked its head above that $1,350 area. I'm looking for further growth. I think that what gold will do over the next months and years is try to establish a new trading range, try to establish a new equilibrium level around which the price will oscillate. The most recent level that we were looking at was 1,250. That served us well, if you like, as an equilibrium level for the past 6 years, but gold's clearly gone way beyond that now. I'm definitely looking for further growth. We've seen 1,450 already this year. I think that we could see that again. We could see gold closer to 1,500 by year end. I wouldn't be at all surprised at that, Ben.
Noted, George. I'd imagine the allocation of gold in investment products that investors hold in their portfolio should change as a reflection of economic conditions. Talk to us about right now how you think that investors should be strategically allocated.
Well, the basic literature suggests that any portfolio could benefit from a strategic allocation somewhere between 2% and 10%.
Okay.
And that wide differential, I think, simply reflects different risk tolerances, different needs, and so forth from different investors.
Noted.
But my sense is that a strategic allocation in the single digits in percentage terms certainly makes sense. The recent study that we did, and we keep updating gold in a multi-asset portfolio, basically mathematically proved that at the 10% allocation level, that was the best, the biggest decrease in risk, the biggest increase in return. So the highest Sharpe ratio was at the 10% level. I think that's looking very realistic given where all the other markets are. The equity markets in the US have gone up for 9 straight years. I think no one in their right mind seriously expects that performance to be repeated over the next decade. So I think that, that a 10% allocation probably makes sense at this point. But as I say, it all does depend on investor risk tolerance. I know people who are much more comfortable with a 20% allocation to gold right now.